For decades, the world's biggest banks secretly rigged the price of money itself. Your mortgage, your student debt, your future. It was called LIBOR. Welcome to the financial timeline, where money, power, and history collide. And nothing is ever as simple as it looks. For years, the most powerful number in global finance wasn't a stock price or a government rate. It was the London Interbank offered rate. The interest rate banks claimed they would charge each other to borrow money. LIBOR wasn't just a benchmark. It was the heartbeat of the global financial system. More than $350 trillion in contracts depended on it. Mortgages, credit cards, corporate loans, government debt. When LIBOR moved, the world moved with it, and almost no one knew how fragile it really was. Every morning, a small group of elite banks, Barclays, JPMorgan, UBS, Deutsche Bank, Citigroup, were asked a simple question. If you had to borrow money today, what interest rate would you pay? Each bank submitted a number. The highest and lowest were thrown out. The rest were averaged. That average became LIBOR. No trades, no verification, no real data, just estimates. LIBOR wasn't measured. It was guess. The system assumed trillion-dollar institutions would be honest, and that assumption would become one of the most expensive mistakes in financial history. Inside the banks, traders noticed something dangerous. If LIBOR moved even 1/100%, billions of dollars shifted instantly, and traders were betting on those movements every day. So why wait for the rate to move when you could nudge it yourself? A message to a colleague on the rate submission desk. A tiny adjustment. A decimal shifted. The change was invisible to the public, but devastatingly profitable. This wasn't hacking the system. They were the system. By the early 2000s, cheating became coordination. Traders across banks met in private chat rooms with names like the cartel, the mafia. Their messages were casual, laughing, brazen. Can you push LIBOR down a bit today? Sure. You owe me a bottle. They joked about fixing the fix while moving trillions tied to pensions, cities, and households. This wasn't rogue behavior. It was routine. Then came 2008. Banks stopped trusting each other. The interbank market froze. But admitting that would trigger panic, so banks lied. They submitted lower rates, pretending everything was fine. LIBOR. The number meant to measure trust became pure fiction. One economist later said, LIBOR was a thermometer that said 98 degrees while the patient was in cardiac arrest. The world was pricing money using a number that no longer reflected reality. In 2012, the illusion cracked. Whistleblowers, journalists, investigators. Barclays handed over chat transcripts. The tone shocked regulators, not because it was clever, but because it was casual. One employee said, "We all did it." And he was right. UBS and Deutsche Bank and JPMorgan Citigroup B. All implicated, all manipulating LIBOR, either to profit or to hide weakness. The fines totaled nearly $9 billion. Sounds massive, but compared to the profits generated, it was insignificant. A cost of doing business. A few traders went to jail. Executives resigned quietly. Bonuses continued. Markets shrugged. The public barely noticed, because when crime is too complex to explain, accountability disappears. LIBOR failed for one reason. It priced trust, not transactions. It assumed honesty in a system built on incentives. When profit and truth collided, profit won. Traders didn't break the rules. They exploited them. Because in finance, morality doesn't move markets in sentiesto. In 2023, LIBOR was officially retired, replaced BSO-FARA rate based on real transactions. Cleaner, more transparent, in theory, but it relies on the same institutions, the same culture, the same incentives. The name changed, the system didn't. The LIBOR scandal wasn't about interest rates, it was about trust. Trust embedded into every loan, every pension, every economy. When that trust collapses, the screens keep glowing, but the foundation cracks. LIBOR didn't just distort prices. It quietly transferred wealth from millions of borrowers to a few insiders. A silent tax. Invisible and largely forgotten. The most unsettling truth isn't that LIBOR was manipulated. It's that the manipulation never really stopped. It evolved. New benchmarks. New acronyms. Same incentives. The price of money isn't just a statistic. It's a story about who decides, who benefits, and who believes. History doesn't repeat. It recycles. And if this story changed how you see the system, subscribe. History has the answers. I'll show you where to look.